Welcome back, friends. In the lead up to the global financial crisis that happened in 2007, 2008, the systemic risks that were building in the markets were overlooked by many. Those risks proved to be calamitous. Today, there are multiple financial vulnerabilities and fault lines. First of all, investors have increasingly borrowed low cost funds, often in foreign currencies, to invest in higher yielding investments in ubiquitous carry trades that are now vulnerable to moves in asset prices and currency values. Number two, investors have wagered on stability by investing in options, either directly or through funds, which hedge a counterparty from volatility. While they pay a premium, they risk large losses where there is more volatility. Likewise, so called risk parity funds must maintain a set risk level, necessitating liquidating riskier assets when the volatility increases. Third, relative value trades that bet on the relationships between assets have become very large, raising risks if they soar. The basis trade, where the investors buy US treasuries and hedge them with futures to lock in small gains, assumes high correlation between the two and the price convergence. Investors also hold large positions on the increasingly unstable spread between the interest rate swaps and government bond rates. Fourth, exposure to illiquidity has increased with the migration to unlisted private equity and credit. The claimed higher returns are in exchange for unquantified liquidity risk. Fifth, the repackaging of risky or illiquid assets via securitizations and synthetic risk transfer, which is a form of credit insurance resembling collateralized debt obligations, has grown again in recent years. These slice assets into tranches of varying risk through complex modeling. The adequacy of less secured tranches of those assets to absorb first losses on the underlying loans and to protect the higher rated securities created remains unverified. These structures introduce vulnerabilities that will be ruthlessly unpicked in a crisis. The monetary volumes of these trades are substantial, as well in excess of the amount of around $1.3 trillion pile of US subprime loans that built up before the 2008 financial crisis. The weakness overall is leverage, both in explicit borrowings but also financial engineering. Falling cash flows from a slowing global economy will test debt levels. US business defaults are at a post-financial crisis high, with rates for highly leveraged private equity, loans, and junk bonds reaching the highest levels since the pandemic in 2020. The IMF has warned of pressures in commercial property and non-bank financial intermediaries. Delinquency rates on mortgage, car, credit card, and other consumer debts are increasing. The unwind in the current market excesses will follow a familiar trajectory. Falling values and increasingly price volatility will trigger calls for more collateral or margin on trades, a scramble for cash, and forced deleveraging. There is also uncertainty around the valuations of the private investments compared with listed securities. Illiquidity will complicate matters as investors facing losses will reduce exposures while others will be required to bolster liquidity to meet the margin calls or cut positions. As you typically sell what is liquid and what has the lowest losses, shocks will spread, increasing volatility and disturbing the traditional asset price correlations. Price falls may be exaggerated because of the reduction in the firms that act as market makers due to industry consolidation and high capital charges on dealer inventory. In addition, trading is now dominated by funds that are actually users and not providers of liquidity. The final vulnerability is the belief in the government underwriting of risk and bailouts. But you find that the major central banks are constrained by their balance sheets, which at around $20 trillion, below the peak of over $25 trillion, are well above their $5 trillion level in 2007. Interest rates are at modest levels, limiting the scope for large cuts, especially with continuing inflation concerns. Deficits under more pressure from military needs, interest costs and debt levels mean that the cavalry may lack horses to ride in the rescue. Markets follow Lenin's dictum: you probe with bayonets. If you find mush, you push. If you find steel, you withdraw. As a crisis evolves, markets test out weaknesses, probing until finding price levels with solid support. Investors will discover again that there are no new financial eras and excesses are never permanent. Friends, that sums up the explanation I have with regard to what trades can trigger the next financial crisis, what can trigger a severe downturn in the equity markets. I believe, however, that a downturn will not be just limited to a specific period in this year, 2025. I believe that there will be pockets of severe weaknesses, not only in 25, 26, 27. This will keep going on for several years. So it will be a financial crisis that will spread over a period of time or many years. There will be good rises in between as well. So it will mask the underlying weaknesses to that extent. We, with our abilities and artificial intelligence that we have developed, have been able to find out which are those periods in each of these years where the falls can be maximum and which can create great amount of trading and investment opportunities alike. To get to know more about where and what is the timeline of all these things to happen, you have US markets for which we give our predictions. You can join that by WhatsApping us on 732-732-2720. For the Indian markets, you can WhatsApp us on 982-086-1044 and join our Premium Plus Telegram group, which will give you all this in a good understanding. And we'll also give you 10 to 12 days predictions in advance, and plus personalized calls and some good. In twice in a month, I intend to call you specifically and explain to you where the markets are headed from here. This is the only group, the Premium Plus and the Premium Elite, where we actually call people and explain to them from us. You take it from the horse's mouth where the markets are headed. So we let us do all the hard work and you enjoy your trading. Happy investing and have a great investing time ahead. Take care. Bye-bye.